Imagine a world where the price of a precious metal, one that's in your phone, your solar panels, even your medical equipment, isn't determined by simple supply and demand. What if I told you that for decades, an invisible force has been flooding the market with ghost supply, keeping prices artificially low and enriching a select few at the expense of everyone else? You probably assume silver's value rises and falls naturally, like any commodity. But what if that's the biggest illusion of all? Today, we're diving into the secret history of silver's ghost supply. A tale of billionaires, bankers, and bold manipulations that nearly broke the global economy. Stick around, because the twists will challenge everything you think you know about money and markets. And by the end, you'll see why this story isn't just history. It's happening right now. To understand the ghost in the machine, we need to go back, way back. Silver has been humanity's money for millennia. The ancient Greeks mined it in Lorient to fund their empire. The Romans used it to pay legions and build aqueducts. But the real game changer came in the 16th century with the Spanish conquest of the Americas. Potosi in Bolivia became the world's largest silver mine, producing so much that it fueled Europe's inflation for centuries. They called it the mountain that eats men. Thousands died extracting the metal that powered global trade. Fast forward to the 19th century. The United States was born in a silver rush. The Comstock lode in Nevada, discovered in 1859, sparked a boom that turned ghost towns into bustling cities overnight. Silver wasn't just pretty, it was money. The US dollar was backed by both gold and silver under the bimetallic standard. But here's where the seeds of manipulation were sown. In 1873, Congress passed the Coinage Act, dubbed the Crime of 1873 by critics, which demonetized silver, shifting the US to a gold standard. Why? Powerful bankers like J.P. Morgan favored gold's scarcity, which kept interest rates high and loans profitable. Silver, abundant from Western mines, threatened that control. Prices plummeted, farmers revolted in the populist movement, and William Jennings Bryan famously railed against the cross of gold in 1896. This set the stage for modern silver markets. By the 20th century, silver's role shifted. No longer primarily money, it became industrial, used in photography, electronics, and warfare. During World War II, the US government stockpiled billions of ounces for the Manhattan Project and other needs. But post-war, demand exploded. Kodak alone consumed massive amounts for film. The U.S. Treasury's strategic stockpile dwindled from 3 billion ounces in 1950 to near zero by the 1970s. Enter key figures who saw opportunity in chaos: the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires with a paranoia about inflation and fiat money. Teasing the twist, these men weren't just investors. They were on a mission to corner the market. But what drove them? And how did an invisible ghost supply emerge to haunt their plans? We'll unravel that cause by cause, but first, let's trace the origins of the cartel mindset that still grips silver today. Origins. The birth of control. The story begins in earnest after the U.S. abandoned the gold standard in 1971. Inflation soared, oil prices quadrupled in 1973, and savvy investors sought hedges. The Hunts, flush from oil wealth, viewed silver as undervalued, trading at around $1.50 per ounce in the early 1970s. They believed governments were debasing currencies, and silver, with its dual monetary industrial role, would skyrocket. Cause? Distrust in paper money led to action. The brothers started buying physical silver quietly, shipping it to vaults in Switzerland to avoid U.S. scrutiny. By 1974, they held millions of ounces. Effect? Prices began creeping up from $4 to $6, but they weren't alone. Rumors swirled of alliances with Saudi royals who shared anti-inflation views. Together, they amassed futures contracts on the commodity exchange, COMEX, paper promises to buy or sell silver at future dates. Here's the key to ghost supply. Futures markets were meant to stabilize prices for miners and users, but they created a parallel universe. For every ounce of physical silver mined, about 800 million annually today, hundreds of paper ounces trade. This ghost supply isn't real metal. It's bets on price movements. If more sellers, shorts, flood the market with paper, it creates illusory abundance, suppressing prices. The Hunts aim to flip this. By buying up contracts, they'd force shorts to deliver physical silver they didn't have, squeezing prices higher. But why ghost? Because much of this supply exists only on ledgers, unbacked by actual bars. Regulators like the Commodity Futures Trading Commission, CFTC, formed in 1974, were supposed to prevent abuse. Yet, as we'll see, they often failed. Rise. The silver bubble inflates. By 1979, the Hunts controlled an estimated 200 million ounces, a third of the world's deliverable supply. Cause? Rampant inflation, 13% in the US, and geopolitical turmoil, like the Iranian Revolution, drove investors to precious metals. Gold hit 850, silver followed. Effect: prices surged. from $6 in early 1979 to $20 by December. The brothers leveraged futures, borrowing to buy more. At one point, they held contracts for 120 million ounces, more than annual U.S. production. Media dubbed it a corner attempt. Jewelers panicked, housewives melted silverware, but the Hunts defended it. We're not manipulating, we're protecting against inflation. Teasing delay. The rise seemed unstoppable. Silver touched $50 in January 1980. But what hidden forces were aligning against them? Why did the market suddenly turn? Hold on. The breaking point reveals the cartel's true power. Breaking point, Silver Thursday. January 7th, 1980. COMEX, pressured by banks holding short positions, changed the rules. Silver Rule 7. Limited positions to 3 million ounces and banned new longs. Cause? The exchange feared a squeeze would bankrupt members. Effect? Prices peaked at $49.45 on January 18th, then wavered. The Hunts, overleveraged, faced margin calls. Demands for cash to cover losses as prices dipped. By March 26th, they owed $135 million to broker Bosch & Co. They couldn't pay. Panic ensued. On March 27th, Silver Thursday, prices crashed 50% in hours from $21 to $10.80. Stock markets halted. The Dow dropped 25 points. Why so sudden? Ghost supply flooded in. Shorts, backed by banks, dumped paper contracts, creating artificial selling pressure. The Hunts empire crumbled under $1.7 billion in losses. But was it fair play or cartel intervention? Evidence suggests the latter. Federal Reserve Chairman Paul Volcker allegedly urged the rule change to prevent economic chaos. Fallout, bankruptcy, and blame. Cause? Massive debts led to investigations. The SEC sued for non-disclosure. A 1988 civil trial found the Hunts guilty of conspiracy, fining them $134 million. Effect. They filed for bankruptcy in 1988, the largest in Texas history. Silver prices languished below $5 for years. The market stabilized, but scars remained. Industrial users like Kodak lobbied for reforms, but the ghost supply persisted. Banks inherited huge short positions, notably J.P. Morgan, after acquiring Bear Stearns in 2008, allegedly holding 25% of COMEX shorts. Failed fixes, investigations, and impunity. Post-crash, the CFTC probed but cleared the Hunts of outright manipulation in 1982, though critics cried whitewash. Fast forward to the 2000s. Silver prices rose with commodity booms, hitting $20 in 2008. Allegations resurfaced. Banks like J.P. Morgan were accused of suppressing prices via massive shorts. Cause? In 2008, whistleblowers claimed JPM manipulated via spoofing, placing fake orders to create ghost supply, then canceling them to move prices. Effect: a 5-year CFTC investigation in 2013 found no evidence, but doubts lingered. Then, the 2011 silver massacre. Prices neared $50 again, echoing 1980. Over 4 days in May, silver plunged 25% amid no supply changes. Why? Alleged naked shorts, unbacked paper dumps to cap the price. Catoosa Research called it a cartel defense. Finally, cracks appeared. In 2018, ex-JPM trader John Edmonds pleaded guilty to spoofing silver from 2009-2015, admitting hundreds of fake trades with supervisor consent. By 2020, JPM paid a record $920 million fine for spoofing precious metals, the largest ever by the CFTC. Traders like Michael Nowak were convicted in 2022 of fraud and price manipulation, yet fixes failed. No systemic changes. Ghost supply endures. Why? Banks profit from volatility and regulators lack teeth. Modern parallels. History rhymes with shocking force. Fast forward to today, December 2025. Silver's ghost supply haunts us still, but patterns are breaking. Remember the 2021 Reddit-fueled silver squeeze? Wall Street bets targeted SLV ETF, driving prices to $30 briefly. But ghost supply struck. Paper dumps crashed it back. Echoes of 1980 and 2011. Shocking data. The gold-silver ratio, historically 15.1, reflecting Earth's crust abundance, now hovers at 80.1. At current prices, silver around $30, gold $2,400, it takes 80 ounces of silver to buy 1 gold. Manipulation? Analysts say yes. Industrial demand, solar up 50% yearly, should push silver higher. More jaw-dropping. Paper-to-physical ratio? Claims suggest 378 paper ounces per physical one in futures. COMEX vaults hold 300 million ounces, but outstanding contracts represent billions. This ghost overhang suppresses prices until physical demand overwhelms, as in Asia now. Repeating patterns. Every breakout attempt, 1980, 2011, 2021, meets ghost supply. But 2025, X posts show lines at Singapore bullion dealers, Shanghai Futures Exchange, SHFE, closing silver above $60 weekly. Chinese imports surged 50% in 2024. India's Diwali demand hit records. Industrial shortfall. 2024 deficit 215 million ounces, fifth straight year. Is the cartel cracking? JPM's 920 milliliters fine exposed spoofing. But with EV solar boom, silver use projected 120% by 2030, physical scarcity could end the ghost game. Yet warnings abound. Volatility spikes, as seen in recent $60 SHFE closes, erased by Western smashes, only to rebound. 3 clear takeaways. First, markets aren't always free. Cause effect shows how rules, shorts, and spoofing create ghost supply, benefiting cartels over investors. Second, distinguish paper from physical. Owning bars or coins sidesteps manipulation. ETFs like SLV may hold ghosts. Third, history teaches vigilance. Silver's booms and busts stem from control attempts. Understanding them empowers you. A warning and open-ended thought. Warning. With global debt at $300 trillion and inflation lurking, silver could explode, but ghost supply might trigger one last crash. Don't bet the farm, diversify. Open-ended. Is 2025 the year the ghost finally fades? As Asian demand dismantles Western control, perhaps the cartel's reign ends, or will new tricks emerge? If this exposed the shadows for you, hit like, subscribe for more deep dives into hidden histories, and comment. Do you own silver? What's your take on the ghost supply? Check the links below for sources and where to buy physical. Thanks for watching. Stay curious, stay informed.